This is a generational buying opportunity, and I'm going to show exactly how in this video. So don't click nothing, don't smash nothing, and certainly don't buy nothing. Just listen and pay attention. Now, the average retail investor always chases the hype, always chases the new hot thing, and never pays attention to long-term fundamentals. Sell very, very, very low, buy very, very high. That's why you see 90% of retail investors piling into the same 5 stocks every few months. Whatever's hot, everybody's piling into that new thing. Now, that approach is proven to be a very unrewarding exercise, and no actual good investor actually uses that approach. What professional investors are looking for is this setup. And I believe we have it. I'll show you exactly when and how and what I'm talking about. But first, I want you to understand this concept. This is how you make money in the stock market without timing, without getting lucky, without none of this stuff, okay? This perfect setup basically shows you a chart in which the business quality of a company is improving exponentially. At the same time, in red, the price at the stock market of said company stagnates and lags behind. When you have these gaps created between the quality of the business and the price at which a certain stock is being traded on, these gaps right here are where actual money is made in the stock market. I'm talking about generational wealth, not 5% here, not 5% there. I just want to refer you back to what happened in 2022, in 2023, 4, 5, and present time with a stock called Palantir. Palantir had this pattern where the stock was stuck at $6, $7, $8 for a whole year. The business kept improving and eventually it caught up, and everybody who actually followed through, stayed the course, have made life-changing money. But the good news for you, if you haven't, this is not going to be the first or the last time this happens. The 3 massive opportunities that we're going to talk about here have 3 elements which make them as such. And these 3 elements must be met in any of the investments I'm interested in. Number 1, we have improving fundamentals, better margins, better revenues, everything gets better numbers. At the same time, the price is either stagnating or, like we've seen with Palantir in 2022, actually dropping. And at the same time, the company is completely misunderstood by the general public and the Wall Street analyst. If we have these 3 elements, this means money if you're patient, if you're disciplined, and if you don't scare easy. If you can do this, you can get this. Very, very simple. Markets by nature are not linear. We as humans really struggle with 2 things. We want everything to be linear and simple. We can't handle exponentiality. And also, we cannot understand incremental improvements. And when I tell you that opportunities happen all the time in the stock market, they keep happening because the markets don't go from point A to point B. Going back to the Palantir example, from $10 to $40, down to $7, therefore whole year, up all the way up to 150, down to 70, up all the way to 190, then another leg all the way to 207, now back to 130, and so forth and so forth. You will always have opportunities. They will keep happening. The problem is that most of these opportunities are not utilized. They're not utilized by investors because people always find a reason not to invest when the share price drops. Now, all of a sudden, the thesis isn't as strong. This time, it's different. Oh my God, it will drop more. Essentially, unlike anywhere else, when you have a discount on great products in the stock market, people get spooked, and most of them do not utilize these opportunities. And because humans are humans, and human psychology isn't going to change, this cycle, this pattern will keep happening again and again and again over the next 100 years, 1,000 years, however long we're on this earth. And because of that, you as a smart investor will have opportunities to utilize these psychological pitfalls to make a lot of money because of this. You will buy very, very low and you will sell very, very high, which is the opposite of the retail investor psychology that you meet every single time in the stock market. Now, I promised you 3 stocks that are prime for this, okay? Stock number 1 is going to be Amazon. Stock number 2 is going to be Palantir. Stock number 3 is going to be Microsoft. Why did I give it away? Because I'm not here to hold you hostage. If all you need is the list of stocks, here you go. Go right ahead, leave, but I promise you, you'll regret it because you won't understand why. And at the first sign of trouble, you're not going to be able to hold on. I want to show you why these opportunities are as such, and that understanding is going to allow you the confidence to sit through a lot of mayhem. So please allow me the next 5 to 7 minutes to build that conviction, or at least start to, in your mind. This is very, very important. So let's talk about Amazon. So Amazon basically went from 400 billion of revenue to 716 billion number over the course of the past 5 years. So going from 400 to 716 billion over the past 5 years, which is an 80% increase in revenues over the course of 5 years. You would expect that the stock price would reflect that sort of business improvement. Now, of course, here's the reality. Right now, you look at Amazon and you're saying, whoa, over the past 5 years, well, we have cash going from 84 billion to 123 billion. That's almost a 50% improvement. Assets went up by 154% to 818 million. And operating margin literally doubled from 5.9 to 11%, 11.2 over the same 5.5 years. So it's not just the revenues. The cash is getting better, assets, the margins are getting better. Amazon have vastly improved its business over the past 5 years. And if you pop open this gets super, super interesting for me. So the price to sales ratio, which means how expensive the stock is, went up from 3.2 to 3.4 in that whole time. Essentially, a 6% increase in price to sales over the course of 5 years, in which the company absolutely killed it. At the same time, the PE ratio, the price to earnings ratio, actually went down from 27.9 to 24.5. Of course, we're talking about forward PE. I never talk about current PE. Forward PE from 27.9 to 24.5. That's a 12.5% drop in the PE ratio in 5 years, where the company absolutely smashed the numbers. The share price went from 160 to 199. That's an increase of 22% over the past 5 years in the share price. Now, let's benchmark this 22% against the S&P 500, right? So the S&P in that exact time frame that we're talking about here did 86%, while Amazon gave us 22%. This is the gap I was talking about earlier. The price isn't matching with the actual numbers that the company is producing. And when that happens, this is where opportunities gets created. Because a company like Amazon should not be discounted. And I'm aware of the many bearish theses about Amazon. But look, I'm going to set the record straight right here. We have very strong earnings, and we have a total misunderstanding of the company, which means that elements 1 and 3 definitely exist. But, and this is the big question, right? Do we have this? Okay? Do we have a problem with Amazon? Because a lot of the bears of Amazon are saying, well, look, Tom, look at the low free cash flow. Look at the massive spending on capital expenditures, on CapEx. This is huge amounts that they're spending on cloud. Now, hang on a second here. If you're trying to establish dominance in the business, and AWS, Amazon Web Services, essentially the cloud service provider of the entire world, they're the biggest in the business. So if AWS is trying to maintain their prime position as the biggest cloud provider in the world, and if you think AI is not fugazi, it's not fake, AI is real, whoever dominates cloud is going to make a lot of money over the next 10 years. So how would you build infrastructure without spending money? And by the way, increase CapEx and decrease free cash flow is the same thing. So to actually separate them is kind of moronic. So you have to understand that when this happens, this happens. I think that if a company like Amazon is investing gazillions of dollars into building an infrastructure, into building a highway on which the entire AI traffic is going to take place, and they're going to have the toll booth, that's actually good. High capex for Amazon means they're expanding. They're creating more data centers, more cloud. This is good. I don't understand how people think this is bad. So to me, classic misunderstanding, improving margins, improving business, and of course, price stagnation. They've underperformed the S&P 500 by 60%. That is insane. Now, the second stock on our list, of course, Palantir. And I want to hold on here for a second. I want to talk about this. Look at what's going on with Palantir over the past year. Over the past year, Palantir is up 10%. At the same time, the S&P is up 11.5%. So Palantir is lagging the S&P 500 for a whole year. Well, that doesn't happen often, at least not for the past few years. And that opens up a window for you to lower your cost basis in Palantir, whether you are a new investor, existing investor. This is huge. Now, I'll show you for a second how big this is, because don't get me started, okay? So revenue for that past year went up from 2.9 billion to 4.5 billion. So 60% increase in revenue. Operating margin, which is the best test for a company's quality. It's not just empty calories with revenue growth. Operating margin went from 10.8 to 31.6%, up 200% in that same 1 year. Free cash flow is up 84%, assets are up 40%, cash is up 40%, and debt is down 4%. So the company reduced its debt, increased the cash, increased free cash flow, literally 200% increase in operating margin, a 60% growth, and the stock is lagging the S&P 500 for the past year? Are we talking here about practice? Shout out if you know the reference. Okay. Look at this. At the 52-week high, Palantir was trading at $207 not that long ago. Now it's at $130. So we're 37% off the 52-week high. Massive opportunity. Okay. Now, if you go to Stock MVP and you run this stock through our scorecard, you're going to find out it gets 100 out of 100 on any single category, whether it's liquidity, whether it's scalability, whether it's growth, institutional holding, and so forth, and so forth, and so forth. In every single category, this is the epitome of a business that's going absolutely insane. And yet, somehow, the stock is lagging the S&P 500. This is prime example. Share price stagnating, quality improving, and the company again is absolutely misunderstood because of people like Michael Burry, who I have no animosity towards, who just put out a tweet that the stock is going to 50. He put out his own newsletter where he says, well, that the company is total BS and fugazi or whatever, I don't know. Whatever the case may be, there's always a reason to sell, and good companies with high beta, good volatile companies like Palantir will always give you these opportunities. It's not the first time we did this. In February of 2025, the stock dropped 40%, okay? Look at the stock, 36% net profit margin. Return on equity is 26%. Now, at the same time, people like Michael Burry are bearish and they're putting out newsletters and everybody's sentiment in the retail community is shaking. Look what the institutional shareholders did with Palantir. Since 2023, institutional shareholding for Palantir went from 670 million shares to 1.24 billion shares. So institutional shareholders, such as Vanguard, such as BlackRock, such as every big shop that we're talking about, these are institutional shareholders. So this class, which is called smart money, so the smart money have increased their Palantir holdings by 85% over the past 3 years, while everybody will telling you that the company is overvalued. Think about it. That's the story, that's the narrative they're building. At the same time, the proof is in the pudding. The money is the walk. It's not about the talk, it's about the walk. 85% increase by big boys that bought the stock while you were being told to stay away. Not the first time this is happening. Number 3 on our list, Microsoft, the holy grail of the bears right now. Microsoft over the past year is actually down 2%, which is insane. Now, it's of course lagging the S&P 500, and we have to talk about this because this is a monumental opportunity, and I'll explain in a second why. There is a massive misunderstanding here, and I'll go through it in a second, but let's just go over the numbers first, okay? First of all, revenue is up in double digits for a company like Microsoft, super impressive. Operating margin is at 45%, up 3% from last year. Assets up 21%, cash up 25%, debt minus 10%, which is very good, reduced debt. Every single category, chef's kiss. This company has some of the best fundamentals you can imagine. And if you look at the forward PE of the company, it's currently at 30. Last year it was 33. So minus 10% on forward PE from a year ago in which all of this happened. The price to sales is currently 13. Last year it was 14, so it's down 5%. So price to sales is cheaper. Forward PE is cheaper. So we have cheaper, we definitely have better fundamentals, but do we have the misunderstanding? The third element, and I'll show you exactly where this misunderstanding is coming from. So the biggest issue that people have with Microsoft is the fact that it has over $600 billion in remaining obligations, basically stuff that people have committed to but haven't bought yet, okay? And a lot of these, a huge amount of these, 50% of these are from OpenAI. Essentially, OpenAI have written a lot of checks for a lot of cloud providers to buy capacity, okay? And a lot of people are starting to realize that with large language models being commoditized, OpenAI isn't as exciting as it once was. Not when Gemini is eating its lunch, not when, the whole agentic workflow is starting to essentially evaporate LLMs. So a lot of people are bearish on the whole OpenAI thing. And with OpenAI holding 50% of the future obligations of Microsoft to build out all these data centers, well, people are saying, well, to hell with Microsoft. Now, this is a huge misunderstanding, okay? OpenAI, I think, is very close to being commoditized, and I don't disagree with this thesis. But to narrow down Microsoft to being completely dependent on one client, are you guys crazy? You literally narrow down Microsoft to a client of OpenAI, and because of OpenAI, you're downgrading the stock? Are you guys insane? We're talking about cloud. Cloud is growing at 40% per year right now for Microsoft. If the AI revolution is real, the best cloud providers will make gazillions of dollars, which means Amazon, which means Microsoft, which means now Oracle, which means Google Cloud Services. Anybody with a highway, if AI is going to agentic and then to robotics, we're going to need as many data centers as these guys can build. With OpenAI or without OpenAI. OpenAI goes away, other clients will take that space. You have to be insane to assume that Microsoft is going to be hurt by OpenAI being commoditized. It's way bigger than OpenAI. You really think an LLM that was going to be the difference maker here? We're talking about robotics and agents. This is massive. They're the second fastest growing cloud provider in the world behind Google. And they're very, very, very important in that area. I would not bet against them, not with an OpenAI even being a little bit commoditized. A lot of concerns on the regulatory side, Microsoft, all this bullshit. We've been through this, not the first time, not the second time, FTC, antitrust, all this stuff. Forget about it. AI fatigue, okay? A lot of people are saying that the AI revolution isn't going to happen. It's the snake that's eating its own tail. It's all from CapEx to CapEx, basically bullshit. Look at how much money is being made, not by hyperscalers, but actual companies with products, with B2C products, with B2B products. They are the highway and the distribution. I think they might be even better than Amazon in certain sense, because while Amazon has AWS and Microsoft has Azure, Microsoft also has the tools to deploy AI in all the business software that they have on top of Azure. So they got the highway and the distribution. And if you are buying this argument that it was overbought, it's not an expensive stock. The share price is certainly not at these levels where you'd say, oh my God, everybody's piling in. It's not an expensive stock at all. At 34 PE, you're crazy. So no, it's not a legacy software business. No, it's not an OpenAI, one client dependency here. Microsoft is cheap right now, and it's not going to be for much long. It's a cloud giant with a distribution platform. If you're betting against it or ignoring the fact that it's being mispriced, you're going to pay for that with alternative costs. Now, for long-term investors, opportunities like Palantir, like Amazon, like Microsoft at this current time, okay, they come from patience and self-control. Okay, those pay. If you buy these stocks, you might feel like an idiot, maybe for a day, maybe for a week, maybe for a month, maybe for 6 months, maybe for a year. Mind you, Palantir was down at $7 for a whole year. That might happen. But if you have the patience and the self-control to withstand that, you're going to end up making a lot of money. Now, we have three companies with strong fundamentals: Amazon, Microsoft, Palantir, and a price decline in the case of Microsoft, price stagnation in the case of Palantir, and with the case of Amazon, a massive lag behind the S&P 500. Now, you're going to see a lot of short-term swings, okay, with these stocks. And every time they happen, if you have the conviction, you should know how to turn this into an opportunity to make money. Going from $40 to $7 on Palantir didn't feel scary. It felt exhilarating to be able to do that. There is no need to predict this market. There is no need to predict any of these companies. All you need is a strong system and a strong discipline. That's why I'm going to do a few things for you. Number one, right now, below this video in the description box, I'm going to put a link to my DCA system, which is going to teach you step by step how to learn and ingrain this system in your brain. So this is hardwired, including when to buy, how to DCA, when to double down. All of this is going to be in that free guide in the link below. Now, if you're looking for the discipline, which is the second phase, join us over the Academy, patreon.com/Tom Nash. I would love to have you there. We'll teach you how to remain disciplined, how to trust the process, how to do this year in, year out, same way me and my 28,000 students have done for the past 5 years. A lot of lives change. We had great success in the Academy. Would love to have you in. Try it with us for 30 days. Money back guaranteed to anybody who's not happy. I'll see you next one. Peace.